Sometimes the modern stock market hands you a perfectly healthy industrial stock that suddenly cracks right under pressure. That is the exact situation we are looking at with Elecon Engineering, which is currently trading right around 413 rupees a share. They are a hardcore manufacturing player, building industrial gearboxes and massive material handling equipment used all over the world. When a stock like this takes a severe hit, we have to figure out if we're looking at a rare mispriced discount or a dangerous value trap designed to catch overly eager buyers. To find the answer, we need to untangle their proven multi-year track record from the immediate operational shock they are dealing with right now. This is Elecon's financial screener dashboard, and the numbers here are telling two completely different stories. On the strong side, their historical capital efficiency is excellent. Return on capital employed sits at 21%, and return on equity is solid at 16.6%. But look below that. Their most recent quarterly profit was essentially slashed in half, showing a massive contraction of negative 50.7%. This collapse is validated by a drop in top-line revenue, with quarterly sales shrinking by 6.5%. When you have double-digit long-term returns colliding with a 50% but deemed cheap doesn't matter if the company goes under. We have to check if they hold enough cash flow to weather a sustained operational freeze. This graphic shows their debt profile. They carry only 273 crore rupees in debt against a massive market capitalization of over 9,200 crore. Because the debt load is minimal, the company is insulated against the immediate threat of bankruptcy, giving management breathing room to fix their internal issues. We have a financially stable company trading at a discount. However, a clean balance sheet and past efficiency don't automatically repair a broken supply chain or lost contracts today. This brings us to the bear case, centering entirely on the 50% plunge in profits. In heavy manufacturing, profits don't just naturally fluctuate by half without a major underlying catalyst. A drop this severe points to structural friction. It means client demand is collapsing, raw material costs are crushing their margins, or they absorbed a massive undisclosed one-time expense. If you buy these shares now, you are acquiring them at a depressed price, but in exchange, you are agreeing to absorb severe, unpredictable price swings in the near term. If next quarter reveals that this profit drop wasn't a fluke, if it is an ongoing systemic issue, the stock price will continue to gap down. For the average investor, the intensity of this current earnings shock carries far too much weight to ignore, regardless of how stable the company looked last year. We need to figure out exactly whose portfolio this stock actually belongs in. If you are a beginner, if you rely on momentum, or if you need steady income from your investments, listen closely. This dashboard shows Elecon's dividend yield sits at less than 0.5%. That means you are not getting paid to wait out a long recovery. Because you have no downside protection and are exposed to massive sudden drops, this stock is a definitive avoid for conservative strategies. Tying your capital up here while waiting months for management to clear the air means you're missing out on healthier companies actively growing their earnings right now. There is only one type of trader who should be looking at Elecon right now, the highly experienced contrarian searching for a turnaround setup. To take this trade, you have to be willing to bet hard cash that the recent 50 exit immediately. On the upside, if earnings normalize, your target exit zone sits between 495 and 510 rupees. Buying a battered stock is lucrative, but never catch a falling knife barehanded. If you buy Elecon, respect the stop loss without hesitation.